This video is going to be all about the Federal Reserve System. Most people have heard of the Federal Reserve System, but don't necessarily know exactly what it does for our economy. Hopefully, by the end of this video, you'll have a better understanding of the Federal Reserve System. The Federal Reserve is often referred to as the Fed. It is the central bank of the United States. Congress created the Fed in 1913 to help promote a safe and sound monetary and financial system for our economy. Today, the Fed performs several important functions, all with the ultimate goal of promoting a healthy U.S. economy. The very first attempt at a central bank happened in 1791. The bank was established in Philadelphia. This bank was shut down in 1811. For the next several years, Congress tried to establish a similar structure. In 1816, Congress agreed to found the Second Central Bank of the United States. This bank expired in 1836. The idea to reestablish a central banking system renewed in 1907 after a series of speculation occurred on Wall Street, which triggered severe banking panic. Citizens were asking to reform the banking system. However, they were opposed by conservatives and money trusts. The need for a central banking system was growing. In 1913, U.S. legislation issued the Federal Reserve Act that created the current Federal Reserve System. The act intended to establish an economic stability in the United States by introducing the central bank. The major functions of the Fed include monitoring the nation's monetary policy, eliminating unemployment, improving price stability, and moderating long-term interest rates in the U.S. economy. Also, to stimulate community development as well as consumer protection by consumer-focused supervision and examination. In fact, the Federal Reserve's most critical function is to conduct monetary policy. Monetary policy is a tool of the Federal Reserve used to influence the amount of money and credit in the economy. The Fed uses three main tools of monetary policy, which are open market operations, the discount rate, and reserve requirements. The goals of monetary policy are to promote maximum possible employment, price stability, and stable long-term interest rates. The Fed undertakes responsibility for monitoring foreign exchange operations to offset disruptive international capital cash flows. One of the most important Fed functions is to promote services to the other commercial banks. The Fed improves the overall efficiency of the payment system by supplying services to these banks. These services include check processing, electronic transfers, securities, automatic deposits, payments, and account management services. In fact, the Federal Reserve System provides services to the U.S. government as well. The Federal Reserve System consists of 12 districts, each one located and serving 12 geographical regions of the country. Regional headquarters are located in Boston, New York, Philadelphia, Cleveland, Richmond, Atlanta, Chicago, St. Louis, Minneapolis, Kansas City, Dallas, and San Francisco. Additionally, there are branches of reserve banks in 25 other cities. Each individual reserve bank is managed by a board of directors. The Federal Reserve banks have several functions: to clear checks, to provide and destroy currency, research the regional economy, which it publishes in the Beige Book, provide economic education, establish economic policy, and approve bank merges. The most important district bank is the Federal Reserve Bank of New York. The Board of Governors is comprised of 7 governors, and one of them is chairman of the board. The board helps to set monetary policy by having all governors sit on the Federal Open Market Committee, setting the reserve requirements for banks, and setting and approving the district account loan rates. The Federal Open Market Committee controls economic policy by using 1 or more of the three tools available to it, which are changing the discount rate, which is the rate that the Fed charges banks to borrow from it, changing reserve requirements, which is the percentage of deposit the bank must hold on reserve to cover all deposits, buying or selling the U.S. Treasury debt from its member banks, and the Federal Open Market Committee also has the ability to grow the money supply in the U.S. lending money to its member banks.